Hey, what's going on? It's Bo Crable here, the founder of Option Scout, and in today's video, I want to talk about the really fun topic of retirement. So, if you think about it, if you think a couple steps deep, retirement is really just a math equation. And this video is actually really important to talk about because, a lot of people who are wanting to retire, it's a very stressful thing. It's a very stressful event. It's a very important event that maybe you've been working on this for literally decades. And the issue with retirement, because again, it's a math equation, pretty much what you need is you need money, dollars, at retirement, and you want to have that money going for you, for an extended period of time, right? And here's the funny thing. A lot of people who don't think of this as a math equation, they don't think of, because retirement is not a black and white thing. And the most people who get, consulting or they're working with a money manager and they're like, how much money do I need to retire? Do you question of where that dollar figure is coming from? So anyhow, I want to break down this equation. So the equation of retiring is pretty much equal to you need X amount of money per month or per year, whatever you want to use the annual basis, it doesn't matter, to pay for all of your expenses and for you not to have to work. Okay, so then obviously you're going to factor in things like if you have a pension, investments, and what ends up being a really important thing is your stocks. You look at the market, you look at stocks, they gain a certain amount of money per year. So if you're like, okay, I'm going to retire at 65. So then if I'm making 4% a year from my stocks, I can sell 4%. I won't even have to touch it. And that's what people refer to is like the 4% rule is like, okay, if you want to retire in America off of $40,000 a year, you need $1 million in assets to retire. Now, here's the thing. Who's making up that number? Well, the people that make up that number says you're going to make 4% a year. Last time I checked, there's a lot of stocks and there's a lot of ways to make money in a very low risk way, not zero risk. Technically, the risk-free rate of return is 1.5%. So it's interesting they're even using 4%. But generally, there's a lot of different ways you can make money with that. I created Option Scout because I love options trading. And I personally believe that if you learn options trading the right way, if you learn about probabilities and statistics with, investing, it can really help you, either retire earlier, have more money in retirement, or need less money to retire. So that's the three things I want to hopefully help you with, that if you learn what I'm kind of about to talk about in this video, then you may think, okay, I'm not going to need as much as I was thinking of retirement, or you can just have more money throughout retirement. Because here's the thing, who wants to retire on 40 grand a year? If I wanted to, I could go retire if I want to, but I love working and things like that, and I'm young, so there's no need for me to stop anything. But let's take it this way. So the S&P 500 it's been on average 8% a year. Okay, so let's just take that as a base level. So you should be getting at least 8% a year. Now, there's a few things you can do to hype up that rate of return. One, and I'm just going to be very blunt with you. A lot of the things I'm going to say, a lot of people's first reactions here are like, oh, that's risky, that's dumb. But keep in mind, when something is risky, you can always do the reverse of it and make it unrisky. Options trading is a perfect example. If you buy a really far out of the money call option that's going to expire soon, that's really, really risky, but you can be the one selling it and make it really not risky at all. So the first thing I want to get out of the way actually is you could borrow from your assets. So let's say the S&P 500 is making 8% a year and you have a portfolio in there. At retirement, you still have to pay taxes, unless obviously you're using a Roth IRA or other different things. I'm not going to talk about those. But you could borrow back and then you could buy, really safe assets with that. And it depends on what interest rate you're paying. Let's say you're paying a 4% interest rate, 4.5%. I think right now, if people go borrow from investment accounts, it's usually about 4.5%. Well, if you use that money and then you bought a rental property, well, even if you made 3% a year after paying your interest expenses, well, now you're beating the market because you own SPY, so you're making 8%, and then you borrow, well, you're paying 4.5% interest, but then if you're making 7% on your real estate investment, well, now you're making 3 or 2.5, so now you're not going to borrow 100% of the value of your portfolio, so whatever percentage, you're making more. That's one way. I'm not going to talk about that, nor would I say I'm an expert with that stuff. What I want to talk about now is selling low risk options. So what do I mean by low risk? High probability option trades. So the cool thing about options, if you look at the math behind it, it has probability. So if you see a lot of people like, oh, I just made a bunch of money with, buying call options, stuff like that, which I've done that before. And, people can make money with that. But if someone's about to retire, the last thing you should do is buy low probability, high risky option contracts. Like that's very irresponsible to do. You might as well go to the casino. You would have more fun probably. But let's say you start to accumulate assets. So you build a stock portfolio. Maybe you have a few hundred shares in Apple. You got 100 shares in Tesla. You got hundreds of shares in the S&P 500. Whatever it may be, you have 100 shares, things like that. If you own 100 shares of a stock, and also if you've heard of covered calls, I'm going to explain another way you can kind of beat the market in a different way, which I'll talk about later for retirement. But anyhow, so covered call is not going to be the whole idea of this video. There'll be something else. If you own 100 shares of an equity, you can then sell covered calls onto it. And if you want to create income from that, or if your goal is just to beat the market, because let's say, through my retirement funds, I want to make at least 10%. Or in other words, you could also say to yourself, I want to just make sure I'm beating the market. A pretty low risk way you could do is you could own the market, VTI, S&P 500, and you could sell really out of the money call options. And you're not going to make a lot of money, but if you do the math, if right now SPY is at 400 and you sell a 440 call option that expires in 2 weeks from now, it's going to probably have a 85% chance above expiring worthless. And what does that mean? If you own the S&P 500, you own it. If it goes up in value, you get it. If you sell the call option at a specific strike price, then what that means is your shares will sell at that point. So obviously, if you're in retirement, you're not going to want to sell your entire portfolio because then maybe you would miss out on some gains, or then maybe you have to pay some tax. That would be annoying. So you want to give yourself a situation where there's a lot of room, where it's like, okay, even if it did sell at that point, I would be pretty happy, right? Like, okay, I've already made 10% so far this year in SPY, so let me sell an option that's 10% out of the money, and let's have it expiring soon. You're not going to get a lot of premium, but you're going to get some. And in this case, some is going to be better than none, because if you're looking to retire, make an extra 2% is 2% you didn't have. So maybe that now pays for a vacation, or that now pays for like lunch or something like that. So that would be a very low risk way to retire faster. So if you kind of look at that way, okay, let me make 3% extra, 4% extra, 5% extra. That's one way. Another way is you can use your portfolio as leverage to sell very low risk cash, or actually it wouldn't be cash secured, naked puts. So if you research, naked options are more riskier inherently than covered options. So when you sell, okay, if you buy a put, you're hoping the market goes down. If you are looking to retire, you probably don't want to waste your money on buying insurance for stocks, which what is that's actually referred to is buying put options. So let's say you have $1 million portfolio, like, I'm going to buy some married puts. At this point, you're practically trading, which, unless you're a professional trader, then, you probably don't want to do this. But what this means is that if you buy those puts, if your positions go down, that put goes up, so then you hopefully cancel the stuff out. If you sell a put, here's what happens. You pick a strike price. Out of the money for puts means that the strike price is below the stock price. And if the stock hits that or below at expiration, you get exercised. So let's say Apple, for example. Apple's at 160. If you sell 150 put, that means if Apple hits 150 or below at expiration, you have to buy Apple at 150. So this is where kind of back to the first thing. I was like, okay, you could borrow from your portfolio, but let's say you don't want to get into real estate, but you still want to borrow from your portfolio and make some money. Well, you could do this in a very low risk way. Again, you could sell options that have a low risk, a high probability of expiring worthless. So here's a good example. Apple's at 160. Sell 130 out of the money put option. So that means Apple would have to shoot down $30 for that to get expired. And if that happens, you probably want to buy. And then, you're using a little bit of your portfolio margin, or just your, margin as a whole. because generally speaking, if you have an account and if you get approved for a couple option levels, you can usually get 2 times the margin of your account. So if you have $1 million portfolio, you can probably go buy up 2 million worth of stocks. So that's cool. But again, now, here's the thing. Any margin you use is higher risk. So again, if your goal is just to slightly beat the market, you probably shouldn't be using all 100% of your margin. Maybe if you have a $100,000 portfolio, maybe use 10,000 of it, and now you try to make a 5% a year on that 10,000, and then boom, that's extra gains. That actually be 0.5% higher. So yeah, that's it. Okay, I feel like I want to make videos about this. I want to teach about this. I want to provide a lot of cool information on Option Scout about this and other lessons, things like that, because yeah, I think the general really low risk, savvy, really way too conservative mindset with retirement investing is actually bad. So being too risky and being way too aggressive is bad, but also I think being too conservative is bad as well. If you're getting 4% a year on your assets, you could be doing better, So anyhow, everyone could always be doing better. If you like this video, give it a like, share it. If you share it to other people that are looking about retiring, and I'll see you in the next video.